The views expressed on this podcast are those of the participants, not of Reuters News.
If you see it as a bank, then you do worry about the economic stuff. The positive there, though, is that if you see it as a bank, it's going to work out, right? You don't have to worry about whether Klarna is going to fail or not. Banks have been in business forever and will continue to be in business forever. Maybe this pitch that, like, we can lend money cheaper and that we're going to lead us to high growth will play out. But they can just fall back on what banks have always done, which is just charge people more money for lending. And in that sense, it's a safer IPO than, say, CoreWeave or some others.
What do you get when you stuff a burrito with the machinations of high finance? Klarna, the Swedish firm that lets shoppers buy now and pay over a series of installments, including for takeout food from new partner DoorDash, is about to give investors a chance to find out. Amid a rocky market for initial public offerings, with high-profile technology firm CoreWeave and gas exporter Venture Global stumbling out of the gate, boss Sebastian Siemiatkowski's nonetheless seems to be pushing ahead for a long-sought listing at a potential value of $15 billion, Reuters reported. That's a steep tumble from the $46 billion once awarded to the firm during the giddy post-pandemic era. What its success or failure augurs for others waiting in the wings, and whether Klarna really can make a claim to reinventing a tech-flavored form of credit, is the subject of this week's Viewsroom. Welcome to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with our fellow columnists about the biggest stories of the week. I'm your host, Jonathan Guilford.
And I'm Amy Donlan. So Klarna, this is, as Jonathan just said, the buy now, pay later business that has partnered with DoorDash, Walmart. It's sort of an alternative to a credit card. And you kind of wonder, if you have a credit card, why would you need Klarna, which we're going to get to in this show. So Jonathan, tell us, what are your views on Klarna? Have you ever used Klarna?
That's the thing. I've never really used one of these services. I always see them popping up now whenever you go to an online merchant. You always have one of these things sitting there. And it's always like, I am a fairly old school guy. I just sit there. I have my credit card. I get rewards for using my credit card. I just do that and I rotate through that every month. Obviously, Klarna, I think it's a bit of a different value proposition depending on income level, depending on the size of the purchase. And also it's just like very different the way it works on the back end and where they're actually getting value, because the kind of classic complaint about credit cards is that they essentially act as the poor subsidizing the rich, that those who fall behind on their balances and end up paying ludicrously high interest rates end up subsidizing a bunch of rewards for people in the kind of middle and top of the income distribution. So there is like genuinely a bit of pull and tug here, but obviously we have two people with us who know much more about this than I do. Joining us this week to pass through everything are Karen Kwok, who has been avidly following Klarna's twisting path to the public markets from her perch as our European tech correspondent, and Stephen Gandel, Breakingviews US banking columnist. So Karen, Stephen, welcome to the Viewsroom.
Hi there.
Thank you for having me.
Karen, maybe you can start us off really simply here. What actually is the buy now pay later business model? Why would anyone with a credit card need this? And like, does Klarna do it differently from its rivals?
So I use it actually all the time.
Oh, interesting.
So basically, I think what it offers is really when you go to like online shopping, buying clothes and so on, like when you go to the checkout section, instead of like putting my credit card's numbers in Klarna, you can just click on it. And then if you put like your email address and your phone number, and then they can immediately just process the payment for you. And I think that's the proposition they're offering here, is like very slick, very easy, very quick. You can just pay it instantly. And the other thing is that they say they offer two products mainly, which is pay in 30 days and pay in 3, which is like a monthly installment that you can split for 3 months. And they say that they claim that they will never charge interest rate if you pay late. And so I think that's the other thing that set them apart from like credit card provider, which will charge you like crazy amount of interest rate if you pay late, right? So, but then that's also leads to the question whether they make money out of it. And for Klarna, their business model is mainly sitting and charging a fee of the transaction from the merchants, which is like the businesses like I don't know, like H&M or like DoorDash, for example. Like they would charge from them to subsidize the funding rather than not subsidize funding, but to make up part of their revenue in order to pay to fund the business, basically.
I was just going to pull Stephen in here now because I have to say, Jonathan, I think this might be generational. We should point out that Karen is quite a bit younger than all of us. So she maybe this is actually, there's a whole new wave of banking customers that are going to use Klarna instead. But I kind of think about this almost like, Death of a Salesman, like Willy Loman and the hire purchase. And like, you put stuff off like that you can't really afford the stuff that you're buying. So like a pizza to me is insane that you would pay that off in installments. Like either you can buy a pizza or you can't buy a pizza. So Stephen, I wondered, is this meeting some need in banking? Like, is there a way to look at the numbers of like that this innovation is actually what the banks should have been doing, should have come up with themselves? How should we kind of think about this? Are they profitable?
The number to look at to see whether this is meeting some kind of need is the usage of it. It's been going up dramatically at Klarna, but also at the other buy now, pay later rivals. I mean, I think the idea is that this is a different way for people to manage their finances. I mean, I've heard Sebastian talk about it, that Klarna wants to sit and be your CFO, right? It's a way to think of your finances like a company would. Banks do a very bad job of making small, medium-term loans. They come with very high interest rates. And so this is a model to improve that. And what Klarna wants to do is be your money bot. It's going to tell you how to fund your lifestyle in a cheaper way. And at times, Klarna says, and most times that's going to be in some kind of interest-free installment. Other times there'll be some interest attached to it. But generally, that's what they want to improve upon. They want to come up with a better model to make it cheaper for people to borrow in a kind of short-term way. And so, in the same way as like a corporation has a line of credit, this is like the idea is that this is your line of credit. And people, yes, you're paying off your Subway sandwich or your burrito over 4 payments or 3 payments. But it's kind of like your operating line. Your lunch is part of your budget, and so money comes in and money comes out like a company would. But I think the problem with this is that it's expensive. The people, when you walk around with free money, when you open up your bags and say, "I have free money to give out," there are a lot of people that show up. This model can work really well. It's riskier. Because it's based on the fact that the person has continued cash flow to pay off that Subway sandwich or burrito 4 months from now. But for some people who can make the regular payments, it will be cheaper. But there'll be some people who can't make those regular payments. And when you go around with a bag of free cash, you end up catching a lot of people who won't be able to make those payments. And so that becomes expensive for the company, and you have to subsidize that somehow. And that gets you back to charging high interest rates.
Right. And just to lean in on that, because obviously I love the idea that this is the equivalent of like a working capital facility for the average person. But like the actual proof point here, right, is how much money does Klarna lose on these loans? Like, what is the loss ratio? Like, is this something like credit cards where I feel like it's fairly well understood, like how many of those loans are effectively going to go bad or get written off? Like, is Klarna outpacing traditional banks' credit card businesses in that respect?
Well, if you look at it the way they measure it, they're doing far better. But if you look at the way a bank would measure loan losses, they're doing slightly worse. And that's a major problem, because if their model is based on being able to deliver, the thing they're solving for is high interest or very expensive short-term loans, then they've got to have a much lower cost to provide cheap short-term loans. And they're right now, the money they're losing on these loans looks a lot like what a credit card loses on its revolving loans. And if that's the case, then they probably have to charge what a credit card charges. And so we're back to the traditional banking model and no real improvement.
It's interesting. I was just going to bring in Karen here as well. And actually, Jonathan, because I know that you have obviously from the US been looking at IPOs as well. And just to give our listeners just a bit of interesting data on the IPO market. So it's been pretty bad of late. So we've got listings in 2022, 2023, and 2024 combined only coming in about half the number of 2021. So not an easy time to be launching a company into the market, which is what Klarna is hoping to do. So I'm just sort of curious, Jonathan, Stephen, Karen, I'd love all of your views on this. Is this a good test when the market is looking shaky, when you have to sort of explain all these things about why this model works, why it can be profitable in the future, why there isn't, I guess, a big threat of regulation for a company that potentially gets people into lots of debt in the future? Maybe Jonathan, you could start.
Yeah, so I don't know. It's like Klarna in some ways has it a little bit easier in a sense because this isn't tied to like the big mega narratives of like CoreWeave is a way of expressing a view on whether AI is real or fake, right? You had Venture Global, which was a big liquid natural gas exporter that was sort of a play on, is the Trump administration going to be transformative for US fossil fuels? And it's like, that gets caught up in like much, much bigger kind of, I guess, like waves of sentiment around whatever the administration or whatever the kind of like technology market is doing at a given moment. And obviously there are also like a ton of like asterisks and things to worry about that were specific to those businesses, especially with CoreWeave. Klarna is maybe like I don't know if I want to say like a purer test in a certain sense, because even though, like everyone else, I'm sure it like includes stuff, and like Karen and Stephen will know this better than I do, but I'm sure they include like a bunch of stuff about AI and yada yada in their pitch. But it is something that like stands a little bit apart from that. So like in a certain sense, it's kind of hard to tell what the environment for that is going to be like. We just haven't had a lot of good, big, pure tests like that in the US recently. But like, I'm curious, Karen and Stephen, kind of like what you think of that.
I guess like one of the things that I saw is that one of the Klarna's comparable firm is actually that if you look at the share price in the past year, they're up 21%. And they pretty much generate pretty much the same amount of revenue, even though the transactions volume is much different. I think that's like a really good benchmark for Klarna to go to if they ever want to get a really good valuation. And I think that's one of the reasons why they see some kind of light that they could try it out a little bit. And if you look at the volatility index, the VIX, it's actually below 20 now, which is traditionally a good benchmark to go for a listing. I think that's the other reason. But I think one thing that is still up in the air is that when it comes to payment and fintech company, the investor will worry investor is that it's really exposed to the economy, because like how much money people spend will affect your volume and your revenue, right? And so given the uncertainty of US economy right now, and maybe there's inflation or how people spend, I think that's like one of the big question marks. How will it affect Klarna's revenue and profit growth?
I mean, I think there's a question of whether investors are going to see it as a tech stock or going to see it as a bank, right? If you see it as a tech stock, then it makes a lot more sense. And it is kind of beyond the economy, the normal kind of macro, the worry that, people have spent down their COVID money and the economy is at the peak, and tariffs and other policy changes are going to cause the GDP to fall and economic activity to fall. So if you see it as a tech firm, then maybe you're not worried about that stuff. And it has had growth, and tech investors are less have less scrutiny about bottom lines. But if you see it as a bank, then you do worry about the economic stuff. The positive there, though, is that if you see it as a bank, it's going to work out, right? You don't have to worry about whether Klarna is going to fail or not. Banks have have been in business forever and will continue to be in business forever. Maybe this pitch that like we can lend money cheaper and that we're going to lead us to high growth is won't play out. But they can just fall back on what banks have always done, which is just charge people more money for lending. And in that sense, it's a cheaper, it's a safer IPO than say CoreWeave or some others, because it has this tech upside, but it also has the kind of downside protection that in their failsafe is they could just become a money lender, which has been around since Shakespeare had it. It's dawn of time.
Well, that's
right?
that's what I'm curious about, right? Because it's like how much is Klarna a bank or not a bank, I guess, is the question. Because like the thing that I'm really interested in that's a piece of all of this is, I cover the big buyout shops, the alternative asset managers, as we call them these days. And folks like KKR are buying up like back books of loans from buy now, pay later companies. And in general, like they've been dragging like a whole bunch of what we think of as traditional finance away from the banks. Is Klarna part of that? Is it enabled by it? Or is this more of an appendage to traditional finance, and Klarna, like at the end of the day, is just going to be backed into looking something that looks more like a traditional bank?
Well, they're trying to diversify and doing that because actually traditionally, because they come from Sweden, traditional how do they fund the loans is that they because they are a bank in Sweden, they just use the deposit of the depositor and use it to fund the loans. And since they expand in the US and other regions, I think they kind of realized that they need to diversify a little bit. So they managed to sell a £30 billion loan portfolio to Elliott last year. And then I think there were some reports saying that they're looking to sell the US loan too, but they haven't been able to. So you can see that they're trying to pivot by selling loans to like fund managers in order to diversify and being away from being a bank. But but it's still like in the middle, like they haven't been managed to do it fully.
Yeah, I think they wanted to prove that they can access this new funding mechanism in this new brave world of non-bank finance and something that's sort of beyond regulation. It's probably a little less. Pressing now that every bank is slightly beyond regulation, at least temporarily with the rollback. But I think while it's not an essential part of their story, it's a story. It's part of the story that Klarna at least wants investors to buy into, so that they can believe that there's sort of unlimited growth in their future.
And Karen, I was just sort of curious about, because Klarna is very much a story about private markets, right? About, kind of crazy valuations that were going around in 2020 and 2021 when the economy was kind of riding high on a lot of stimulus. But you've written about how, basically Klarna has had to kind of get through that really has changed, that the kind of private valuations have kind of come down to earth. So what kind of lessons do you think, Klarna will give us about what's happening in that like private tech ecosystem? We obviously were recording this on Tuesday when OpenAI, Karen, you wrote another piece about OpenAI's valuation and a very interesting thing about basically how it eventually gets to profit.
I mean, that's the thing. I think that's in private market because of the liquidity limitation. It's a little bit hard to judge like how to make sense of those valuation numbers, and it could go up like Klarna did. Like it did like $46 billion valuation, and then down to $6 billion in a year time, because they need to raise new money, and they comment because the whole funding raising environment just changed. I guess like it says a lot like how this could also change very rapidly in the AI new world, that once those sentiments is gone and what you see right now, it could be just push away very immediately, and it takes a long time for it to get back to where you want it to be. I think like Klarna IPO, the expected valuations is around like between 10 to 20 billion, but it's still nowhere near the 46 billion that they used to be valued when back then, right? So you can see that a lot of these numbers is just, it could be a bubble, and it really it doesn't really translate immediately and directly to profitability as well.
Right.
I think that some of this reflects, some of this makes the argument for it's more bank-like. I mean, if the idea is that you're going to fund yourself with deposits and make short-term low-interest loans, that was a decent business model in 2021 when interest rates were rock bottom. You didn't have to pay much for those deposits. It's less profitable at a time where you have to pay 4% interest or more for your deposits. And you can see that in Klarna's finances, that their funding costs have gone way up. And so if you believe that they're going to have to abide by the typical laws of finance, then they may struggle in a higher interest world. It makes sense that they're not worth as much as they would when interest rates were zero.
All right. And we're going to find out if investors even agree that they are worth this diminished amount very soon, presumably. Until then, though, this has been fantastic. Stephen, Karen, thank you so much for joining us.
Thank you.
Thank you.
Thanks for tuning in. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune in to our sister podcast, The Big View, every Tuesday, as well as other great podcasts from the Reuters team. If you like what you heard, please follow The Viewsroom and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.